The moment of truth for Saudi Aramco, the highly anticipated IPO prices as OPEC faces questions on compliance, demand, and too much supply. Crisis in Chile. The plummeting peso pushes local copper prices to an all-time high. Potato famine. It is a race to stockpile French fries as potatoes are hit with bad weather, tightening supplies. I'm Alix Steele. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we want to kick it off with Spot On. It's our analyst and investor take on our big story, and the spotlight is on OPEC+. According to a delegate, the group agreed to deepen its production cut by an extra 500,000 barrels of oil a day, formalizing the extra supply reductions the group's already been making, also making a concession to Russia. Joining me is Anne-Marie Horton of Bloomberg News on the ground in Vienna. So what did we learn? What are the actual cuts?
That's a very good question, Alex, and we're still waiting to find that out. What we do know is that they have this proposal and they agreed in principle for these 500,000 barrels a day. That takes the deal of 1.2 million barrels a day to 1.7 million barrels a day. But the devil's in the details. Is this a cosmetic cut, or are we going to actually see real barrels come off the market? The big question is, how is this going to be distributed? Because basically what it looks like right now, if we do it on a pro rata basis of what they've already been cutting, it's basically the entire year has been this 1.7. And we've seen actually the more details that have come out of the deal and out of the ministers' meeting, the market has actually taken a bit of a leg lower. So that's what we're still waiting to find out here in Vienna. And once traders know those details, we'll be able to see whether or not we're actually going to see this really affect the physical market, Alex.
I think a large part of that also is Russia. So apparently they got a pass on condensate. So now their quota won't include that, which basically means that just by that financial engineering, they'll now be below their quota. You caught up with the Russian energy minister. What'd you learn?
Yeah, that's right. The condensate has been a huge issue for Russia. And basically what they're saying is that it should have never been a part of their total crude output. And without it, it puts them in compliance. So it could be a bit of a loophole for Moscow. When Manis Krani, my colleague, spoke to Alexander Novak on his way out of an earlier meeting, and he actually was talking about the distribution of 500,000 barrels. And he said we had to wait and see. Take a listen.
We have not yet reviewed the distribution of these 500,000 barrels per day of cuts between countries, because this distribution will be reviewed by the OPEC conference and by the ministerial meeting.
So that was Alexander Novak speaking to Manis Krani on his way out of an earlier meeting here in Vienna. That 500,000 barrels a day, that's really going to be key for the market, Alex.
All right, thanks so much, Bloomberg's Anne-Marie Horton. Great reporting. And oil prices pretty unimpressed with the news in the middle of their longest winning streak in 7 weeks. I'm joined now by Bob Yager, a Yager Energy Futures strategist over at Mizuho, and Thibault Lecomte, a CEO and founder at Calendar. That's a company that provides local data on the evolution of climate. He joins us on the phone from Paris. Bob, let's start with you in the oil price. Why not seeing a bigger reaction to this? What's your take?
At the end of the day, supply, there's so much crude oil supply out there. Basically, crude oil global demand will increase by 1 million barrels in 2020. The supply situation is forecast to increase by an all-time record over 2 million barrels a day. The existing record is 1.9 million in 1978. So we're going to outstrip the global demand situation by well over 1 million barrels. And at the end of the day, that's going to put a cap on prices.
So what do you think is actually priced in? Because we've seen some rebuilding of some net longs in WTI and Brent, along with the oil price, as we've had this rally over the last 7 weeks. But in reality, what do you do?
Well, I think that everybody was waiting on this meeting. They were hoping for some kind of big number to come out, led by the Saudis. It really didn't happen. Plus, you have this condensate situation. That's kind of an easy way out. They basically agreed to the Russians' request to keep them in the program, in my opinion.
So, and this is sort of showing the run-up in positioning as well as the oil price. And this is the backdrop for Saudi Aramco pricing its IPO. Now, Thibault, you've done some work on sort of a risk of climate change. In the prospectus, Saudi Aramco tried to address that risk, basically saying that, yes, climate change could impact things like oil demand as well as other hydrocarbon demands. What's your base case for the risk for Saudi Aramco?
Well, actually, we look on the risk for Saudi Aramco production. Saudi Aramco infrastructure. And we pinpoint 4 main risks. One is warming. With higher temperature, you have damage to equipment, damage to workers as well. And the second one is food, especially on the western coast of Saudi Arabia. And then we have sea level rise. And finally, access to fresh water.
So what kind of drag is it? Like how much could that suck off of the valuation and the pricing of Saudi Aramco?
Yeah, it's actually very hard to say without more access to more information, and I think it's a key problem here. But what we demonstrate with our research is that these risks are significant. They cannot be ignored.
So, Bob, how do you look at it then as an investor? Because Saudi Aramco had a hard time marketing this outside of Saudi Arabia. Temasek, one of Singapore's sovereign wealth funds, basically said we don't necessarily want to invest because of climate change. How do you look at it?
Well, the way I look at it is it's the all-time record IPO. They accomplished that goal, and the total valuation is a little bit over 1.7 trillion, within striking range of Crown Prince's goals. So in that regard, it's a success. Now, listen, we may trade lower. They picked us a good time right now. Crude oil has been trading above $50 for 11 months now. It could easily slide below, but right now it's above, and it's at the top end of the range it's been at since September. And it was a good time to do the deal. Listen, at some point, it's crude oil. We'll trade back above. They basically have 3.5% that they're loaded up on that they would like to get out in the market at some point. They're going to wait until there's a good time when crude oil prices are bid to take that to the global market and execute the program.
But in terms of, say, the investor hatred or dislike of oil stocks, how much of that do you think is just cyclical and you need a higher oil price and better demand versus how much is structural and investors actually starting to price in climate change and CO2 risk?
I think right now, ideally, people look at that, the future of the planet type situation. But when you get a ripper in crude oil, that changes minds really quickly.
Okay, fair enough. So like fickle investors in that respect. Okay, so Tybalt, you've done the work on the climate change issue when it comes to Saudi Aramco. Can these companies fix it?
I think it's pretty easy to fix it for future infrastructure. If you build a new refinery or new infrastructure, any infrastructure, you can take into account what will be the temperature or the precipitation during the time of this infrastructure will be exploited. It's a bit harder when you already have installations which are very intensive in capital, very complex. It's difficult to adapt them to conditions that are different than the ones they were expected to meet.
Tybalt, Saudi Aramco would say that its geology is actually the best in the world and that they have lighter carbon than the rest of the world when they go and drill for it. Is that a valid pushback to the climate change concerns?
Well, actually, it's a bit beyond my point because, I don't work on greenhouse gases emission. I work on the effect of this emission and the effect of climate change for companies. Yes, maybe their whole has a good performance for emission, but they will be victim of climate change as well, and they have to think about what will be the impact for them and on their infrastructure.
All right, Bob, last word to you. I'm starting to get some calls for $40 oil. Do we see that?
I don't think anytime in the near future. It's winter time. We should have a bid in the heating oil market, which, by the way, is not really happening. But it's that time of year. We should be bid there. And we've been chopping around in this range for quite some time. We're at $50. This is the highest we've been since September. So we had our first draw in storage this week in 6 weeks. And if that continues to be the case, it won't happen anytime in the next couple of weeks.
All right, Bob, thanks a lot. I appreciate it, guys. Bob Yager of Mizuho and Tybalt Lacan of Calendar. Thank you. Coming up, Chile has been engulfed in protests and violence for over a month. We're going to talk about what that means for copper supply and prices. And the latest voice to weigh in the Saudi Aramco IPO, the CEO of Petrobras, Roberto Castelo Branco. I caught up with him at the New York Stock Exchange earlier this week and asked him what he thought of that competition.
Saudi Aramco is a very efficient company, very large reserves, very low cost. It can thrive in a low price scenario. That's good for the global capital markets to have a company like Saudi Aramco listed. We don't care about that.
I'm Alix Steele. This is Bloomberg Commodities Edge. A time now for the data dig. We delve deep into the trends of the week. So first up, we get oil inventory numbers delivering a bullish surprise. You got a 4.8 million barrel draw, the bulk of that actually coming from the Gulf Coast. Yet underlying demand still weak. You do have a build in gasoline and diesel stocks. And do you want some fries with that? Because if you do, you better start stocking up on potatoes. You got cold weather and wet weather is hitting crops hard, causing a shortage of the starchy tuber in North America, which may affect the availability of French fries. So who wins in this French fry squeeze? The answer is fry supplier Lamb Weston Holdings. That orange line there, shares really rallying this week on the news. And it was an integrated merger that made sense, but the street really didn't like it. And that's Cleveland Cliffs. That stock really dropping after announcing its plan to buy AK Steel Holding. Cleveland makes iron ore an input into steel. CEO Lorenzo Gonçalves was on the call, and he was asked a question about transferring pricing risks. And he said, "It's our company. After we close, we can do whatever we want." The best to hear if you're an investor there. All right, now let's get into the ring because we got copper prices versus copper prices. This chart shows copper prices in the Chilean peso, which is that white line, and the blue line, which is U.S. copper prices. The more the currency sinks, the higher prices go in local currency terms. I'm joined now in London by Max Layton, Managing Director at Citi Research, overseeing European commodities research in industrial and precious metals and bulk commodities. Max, good to see you. So how much more juice and upside do we have in local copper prices in Chile?
Well, that's a great question. I mean, certainly what we've seen already is a massive increase in local currency prices. They're up, even though the Chilean peso has appreciated recently, they're up around 15% in local currency terms since the middle of this year. And that is probably going to result in assuming that cost inflation doesn't come through in Chile, that could be incremental margins for domestic producers in the order of $4 billion. In terms of the outlook, it's pretty tough to say what's going to happen. It's been very, very volatile on the currency side.
So when you talk about margins, I mean, if I'm going to make a better margin as a producer, I'm going to want to go invest more money and then produce more. Is that going to be sort of an overhang here for copper? Does that happen?
Yeah, we've done a lot of thinking about this. It's a tough question, but the answer that we've come up with is that we don't think so. Essentially, for the next 12 months or so, you're going to have a lot of concern and doubt and question marks about what's going to be in the potential new constitution. And in the build-up to that, you're probably not going to have significant capex over and above what's already been committed in Chile, regardless of the potentially strong margins resulting from the recent currency depreciation.
And this just comes on sort of a downturn in capex anyway, from 2012 to 2017. We have a chart actually from your note that shows production and sort of the capex that's not been invested. Where's my big supply crunch, and when does it happen, and what might resolve it?
Actually, the big supply crunch is happening now. It's been happening this year, and it's going to continue to happen next year. So through 2020, we think that the fact that capex has collapsed by an amount only equaled 20 years ago. So it's the second, roughly equally the biggest collapse in capex that we've seen in copper over the past 20 years, and if not ever. That is driving down copper mine supply last year, and we'll probably have no growth next year. Beyond that, it's a little bit more difficult, but the next couple of years, this year, next year, and potentially the year after, lack of copper mine supply means that copper is probably going to be heavily leveraged to any demand uptick.
So what can we expect for next year in terms of prices?
Well, unfortunately, a lot of that is going to depend on the trade war. Our own view is by the middle of next year, copper will be getting up to about $6,500, so more than 10% upside from the current price. But implicit in that, we have the phase 1 deal happening, some hope of a phase 2 deal happening, and a continued gradual and modest Chinese easing, which should be more than enough to see copper register about a 200,000 ton deficit, have margins improve, have sentiment improve, positioning improve, and that's what gets you to 6,500.
All right, Max, really appreciate that. Citi Research's Max Layton. Time now for the note of the week, and it comes to us from Occidental CEO Vicky Holub. She tells our Bloomberg reporter Kevin Crowley how she manages Carl Icahn's stress. She says, I just get in my kayak. I go kayaking on the bay in Galveston. What bothers me more than anything is our shareholders are going through some stress. I care about that. I want to lower their stress, and I want to do it as quickly as possible. All of that coming for a proxy fight for the board at Carl Icahn issuing against Occidental. All right, coming up, Anthony Gurney, Ardmore Shipping CEO, will be joining us, explains how his company is bracing for a sea change in the industry. This is Bloomberg Commodities Edge. 200 leaders gathered to talk climate in Madrid, and next week, Brussels takes center stage. EU leaders will commit to cutting net greenhouse gas emissions to zero by 2050 as the new president of the European Commission, Ursula von der Leyen, unveils her ambitious plans. Among them, easing restrictions on state aid for companies, higher targets for 2030 emission cuts, penalizing imports from looser countries, would have looser emission controls, plus providing $1.1 trillion in climate financing over the next decade. And it's all to fight this chart. This shows carbon dioxide emissions in some significant countries over the last decade, and China really leading the way with an increase in those CO2 emissions, but the U.S. also ticking up as well as India. And this brings us to Commodity in Chief, where we focus on one executive in the commodity world, and today it's Ardmore Shipping CEO Anthony Gurney. First, a closer look at new shipping rules coming into effect to help combat CO2 emissions. 15 large container vessels give off as much pollution as 760 million cars, and that is about to change. New International Maritime Organization rules hit January 2020 and limit the sulfur content in maritime fuel. There is a grace period, but the rules are here to stay, and you can't cheat. If you do, you pay a big fine and risk your vessel being labeled as unseaworthy. Here are your options if you're a shipper. You can buy an exhaust gas cleaning scrubber, which cleans out the sulfur dioxide. Most popular are open-loop scrubbers, but they release a sludge into the ocean. The problem, certain countries like China and Singapore are banning them, and they come at a high price, $2 to $4 million and at least $500,000 in operating expenses a year. Or you can use IMO low-sulfur compliant fuels like diesel and marine gas oil. Analysts say demand for these could grow as much as 2 million barrels a day. The problem? Supplies. Refiners can run the U.S. light crude and get diesel, but gasoline as well, potentially creating a glut. Or they can choose heavy sour crude that comes from Canada and Venezuela. You get more diesel, but that crude is in tight supply. The result could be not enough product, too much demand, and potentially high diesel margins. Maersk says the new rule could add $2 billion onto its annual fuel bill. Okay for a company with a market cap of near $30 billion, but a deal breaker for a smaller 10 to 30 vessel shipping firm. The result? Some shippers lose money, or worse, go bankrupt, while others see their business boom from moving more product around the world. It's good for some refiners who can use lots of different types of crude. It's bad for others. Crude and product spreads go haywire, and vessels turn to alternative products like LNG. Any way you slice it, IMO 2020 has the power to change the shipping world. I recently caught up with Anthony Gurney and asked him if the industry was really prepared for IMO 2020.
Nobody has a real incentive to be proactive. Some traders are speculating and stockpiling, but when you talk to people in the industry that handle the fueling of the ships, they basically are waiting for the demand to come. And once the demand comes, then they'll source the product. And at that point, it might be a little bit too late. We think it's going to be very, very disruptive. We think that the demand for gas oil is going to be much higher than people anticipate, and that's going to result in a lot of cargo movement around the world. Because
tanker rates are so high, tankers aren't going to want to retire their fleet to upgrade to a scrubber for IMO 2020. They want to take advantage of the higher rates. Yep. A, are you seeing that? And B, what's in the implication come January 1st? Yeah, so we're definitely seeing that, ships that were planning to go into the fourth quarter to install scrubbers, they're just earning too much money right now. So they're going to go past the Chinese repair yard where they were going to do the business and continue on to do the next load. Because in reality, even at 100,000 a day, they're probably leaving $6 or $7 million on the table by going in. As a consequence, there are going to be fewer scrubber installations, which means more demand for compliant fuel, mostly gas oil. Aha. So how much more demand for gas oil are you thinking about versus, say, 8 months ago?
We don't know yet, but it could be quite significant because the other thing that's happening now, that generally when tanker rates are strong, ships speed up. And when they speed up, they burn more fuel. So we have an accumulation of events now, which we think are going to culminate in just much higher demand for gas oil than expected.
Walk me through sort of what this winds up meaning for your business, short, medium term.
Right. So for our business, we like to say that our ships are the taxi cabs of the world product tanker fleet, and so we pretty much go where we're needed by the oil traders and by the oil majors. So what it means for us is higher refinery throughput means more product to move. It's going to be very disruptive. It's going to result in a lot of price volatility on a very physical local basis, so there'll be a lot of cargo movement. It also means that, while the gas oil will be in demand, unfortunately a lot of extra naphtha and gasoline will be produced as well, and that needs to go somewhere. But there's going to be a big issue around what to do with the old fuel, the high sulfur fuel oil. Now, obviously, refineries will be reprocessing it to break it down into marketable products, but a lot of it is going to get stored and shipped back to the Middle East, for example, for power generation and other places. So we think that there's going to be a fairly vibrant trade admittedly for crude tankers, not our ships, but there's going to be a lot of trade around moving the old fuel away. Where
do you see the biggest dislocation then, as that thesis plays out?
There are pockets that, I think the point that we've been making for a couple of years now is that the capacity for production of the new fuels is there, but it's not in the right locations, right? So, for example, Northern Europe is always short diesel. The IMO 2020 switch is going to make that shortfall, much larger, and that's going to have to come in from somewhere. Some of it might come in from the U.S. Gulf, but a lot of it's coming in from the Far East. These are generally long distances, right? Similarly, Singapore is net short diesel. That'll be coming from North Asia and from the Middle East. So it's really a kind of a scrambling and dislocation that we think could take, the better part of a year, maybe longer, to get back to equilibrium.
That was my interview with Ardmore Shipping CEO Anthony Gurney. And here's what's on my commodity radar. So Tuesday, you get the WASDE report, World Agricultural Supply and Demand report, and Wednesday, Saudi Aramco shares start trading in Riyadh. That does it for Bloomberg Commodities Edge. Catch us every week at Thursday at 1 p.m. This is Bloomberg.